morning. Thank you guys so much for tuning into today's video. Today is April 11th, 2025, and to begin today's live stream, I do want to take a look at the economic calendar here. So we do have core PPI, which actually dropped from, or I guess not dropped, but its forecast was 0.3%. It's actually at -1%. And let's see, so it's changing the price of finished goods and services sold by producers, excluding food and energy. Actual greater than forecast is good for currency. Sources change. So if it's -1, what does that mean? Let's see. So if PPI is -1, so if PPI is -1%, PPI is one of the leading inflation indicators. So producer price index, yep. Producer prices fell 1%. What does that mean? Producers are getting less money for their goods, may indicate weak demand and excess supply. So the prices fell over the Fed or central banks may view falling PPI as a reason to be less aggressive with rate hikes. Could even consider rate cuts if deflation persists and demand is too weak. So if energy and commodity prices drop significantly, that's good for input costs, but could signal that growth is slowing and we're headed towards a potential recession. Ooh, so that's not very ideal, right? So here, let's see. So yeah, I mean, PPI, CPI actually dropped here as well from it was forecasted to be at 2.5%, but it's actually a 2.4 year to year, and CPI dropped. So if CPI drops, but the thing is, in theory, shouldn't it be better for consumers if prices are dropping? Consumer sentiment is no good too here. I mean, we're at a 54%. Pre-COVID, at 2018, it was 90s, high 90s here, right? And yeah, it just began to slowly drop during COVID, and we never seem to have really like fully picked it back up. Not. See. So if falling CPI, weaker demand, deflation risk, looser monetary policy. So a decrease in this is very interesting, where inflation has not inflation, sorry, recession risk, and a possible recession could occur. With these indicators here, it's not ideal CPI, right? With these negative numbers really indicating that inflation is dropping and demand is dropping, right? So yes, so a decrease in CPI and PPI, especially being both lower than expected, means that prices on goods and services are dropping and rising more slowly than expected, Consumer price, when it measures lower than expected, means consumers are paying less or prices rising slower. Yeah. PPI, producer prices, wholesale business are receiving less for their goods. Cooling inflation, lower costs for both consumers and producers, less pressure on. While falling prices can help consumers, weak consumer demand, slowing economic growth, and pressure on company earnings. This is very crucial here, right? Oh wow, look at that. Eggs in the United States used to be about $8. Now what happened with this significant drop? That's so interesting. That is so interesting. Wow, what? Okay, well, I do want to keep that on mind. See where our debt is. $36 trillion in debt. Doge. That's interesting. I do want to see how much it is if I go to Target right now and I were to try to buy a carton of eggs. I want to see how much that would cost, but I mean, $3 seems reasonable. But let's go to the actual charts here for now. And let's take a look at the technicals. So on the daily time frame, okay, give me 1 second. Once it loads, I should have a more better depiction of what the daily is trying to tell me. All right, so this is the daily candle from yesterday. It was a down closed candle where, you know, I can't really say that I want to see us take out previous day low or previous day high. It's kind of giving it like a neutral stance here where I don't want to force anything. With the way that we close, I don't want to force anything for sure here coming into today on the daily time frame, especially whenever we started to sell off here, right, and create this down close candle with this move lower. There's not really much displacement, and we're also trading within a bullish fair value gap here, so looking for any sell positions is going to be a little bit more difficult, and likewise with bullish conditions too on daily time frame. At least I was favoring higher prices yesterday, but with the way that we didn't show any respect to this fair value gap, or I mean we're showing respect, but we're not getting that energetic bounce up, right? That's kind of what I wanted to see, but it's kind of lethargic, you can say, in prices, and it just not as strong as I thought it should have been. So I'm not coming into the daily time frame. I'm not going to force higher or lower prices. I have a neutral bias coming into the daily time frame. But if I were to zoom into let's say the 4-hour time frame, right, or the 6-hour or the 8-hour, I might have a better perspective of what prices wants to do here, at least. So during the morning at 10 a.m., we have a closure on the 4-hour candle and this 8-hour candle. Depending on how we close on those two specific candles will give me a intraday bias of what I want to see prices do, right? So if we close bullish here on the 4-hour time frame on NQ, then I would be favoring buy side delivery, right? But if we close bearishly, so if this candle closes very bearish, then I would be favoring the opposite direction. Lower prices, I would like to see the sell side delivery. So coming into this specific morning, I don't necessarily have a bias. I'm just going to wait until the 4-hour candle and the 8-hour candle closes before I really, decide a side or pick a side here. So I'm just gonna wait, be patient. one thing that I do want to mention is that there is a lack of SMT divergence here between NTU and ES at the highs and the lows. So it's kind of, it could go either way here. Today was PPI, and usually PPI has a larger range than this, but it's the market's been wonky. Or not wonky, it's been very volatile, but with PPI and CPI being yesterday and today, I'm not too sure why we didn't have like much movement, right? I was anticipating a little bit more movement in comparison to like Wednesday. If Wednesday moved 2,000 points with no CPI, then Tuesday should have done, or not, sorry, but CPI day should have done even more than that, right? But we didn't have much of a move that I was anticipating. But yeah, like I stated, I do want to wait until the 4-hour candle and this 8-hour candle closes before I really pick a side, right? Either bullish or bearish. I just want to wait until we close. That will give me more confirmation of what I want to see on prices. But let's get into the Wall Street Journal. I do want to take a look at what's going on here fundamentally and geopolitically. So here we have China raises U.S. tariffs to 125%. So any Chinese importers of United States good will have to pay more than what the item that they're buying from the United States for. So let's say a Chinese man is trying to import a United States car that costs $5. He would have to pay $5 on top. Yeah, bye, man. He would have to pay on top of that already $5, existing $5, another $5, and 25% of that $5, right? So I think this is kind of interesting, right? Pretty interesting scenario that we're in. So he would have to pay the Chinese man would have to pay $11.25 in total for purchasing a $5 United States car. Let's see here. So China raises tariffs on United States to 125% in the latest Chavo. Dollar falls, gold prices power higher. And this is like normal, right? If the dollar declines, gold prices should be trading inversely and trade higher if the dollar is dropping. Trade war between the world's largest economies spiraled further on Friday, with China lifting tariffs on the United States to 125% and scoffing that further American levies would be seen around the globe as a joke. The Dow Industries and the S&P 500 and the tech-heavy NASDAQ composite were all muted in the morning trading, with more dramatic moves in other markets such as gold and the dollar. Let's take a look at the dollar. Actually, I didn't really get to see too much of it. Oh wow. The dollar here is actually weakening. And if the dollar weakens, bond yields should actually be rising. Oh wow. This is quite the scenario that we're in here. Yeah, right, so let's see. Bond markets remain under pressure, with benchmark 10-year treasury yields briefing topping about 4.5%. If the yields are dropping, if the yields are rising for the bonds, the treasury bonds, and bills, or just in general, the prices of those bonds, notes, bills will be decreasing, right? Demand for United States treasuries or declining. In global markets, the Stokes Europe 600 edged down, while Japan's Nikkei 225 index dropped 3% to close the week. The dollar extended its week-long decline. China's decision marked the latest escalation in tariff tit for tat that has grabbed global attention and rattled financial markets this month. Earlier, Canada's Prime Minister Mark Carney said his government will counter unjustified U.S. levies on 25% on steel, aluminum, and cars, and inflict maximum pain. So this is Canada kind of doing the same thing as reciprocal. And let's see. So the showdown has hammered U.S. assets, with major indices falling 6% to 7% since President Trump announced his tariff plan Wednesday afternoon. Gold has soared to fresh all-time highs, reflecting concerns about geopolitical conflict and the outlook for financial markets. So gold, let's take a look here. Do you want to see gold futures? Yeah, like, oh my gosh. Wow. Just wow. What? That's amazing. Gold is rising. Usually whenever gold rises, dollar declines, which is not ideal. That just means that the dollar is becoming really weak. But United States exports should be cheaper and more at a competitive price. Some of the most intense action has shown up in foreign exchange. The U.S. dollar fell Friday for the fifth straight day, on track for its worst week since 2022. The euro was up much as 2% at 3-year highs. In part, the action reflects anxiety over the apparent instability of the global economic situation. On Friday, China said it wouldn't continue to match any levies increases by the United States. Even if the U.S. continues to impose higher tariffs, it would be economically meaningless and would become a joke in the history of the world economy, Beijing said. JP Morgan's Jamie Dimon warned that the economy is facing considerable turbulence as his bank reported quarterly results. Likewise, Larry Fink and BlackRock highlighted clients' uncertainty and anxiety about the markets and the economy, drawing parallels with periods such as financial crisis and the pandemic. The partial suspension of United States tariffs remained fragile, and the European Union must continue to prepare countermeasures to defend itself, French President Emmanuel Macron said earlier Friday. European Union Trade Commissioner Maros Šefčovič will meet with United States officials in Washington on Monday, an EU spokesman said. Yeah, Jamie Dimon is the CEO of Chase, JP Morgan, actually went out and did a interview and stated that there could be a possible recession. But the thing with recessions is that you don't know if when a recession is going to occur or if you're already in one, right? With the idea that tariffs are going to raise car prices and just automobile prices in general, that's already going to weaken the demand for cars in the United States, or just purchases of cars in the United States, right? As the consumer fears that the car prices right now are going to be in, or just high, and they're not going to want to buy any cars in the state that we're in right now. Like, that's just how I feel. Like, that's psychologically, I feel like that's something that they are feeling right now. And I mean, their consumers are probably gonna think that, hey, I'm gonna let this, this whole tier 4 just settle down, and so I can get a better and clear view of things. And while we do so, I'm just going to not buy any cars. I'm not going to consume. And that's recessions, right? Automobile manufacturers, whatever, they're going to have to lay off people. A very key component to a recession is high employment. So we'll have to see where the unemployment claims are, but that will be next week. So we'll see where we're at next week. It's about to be 10 a.m. and with that, there's that 10 a.m. candle, or 10 a.m. open. So let's see. How did we close here on the 4-hour candle in this 8-hour candle? Well, we actually don't have a bias. With the way that we close here on the 8-hour candle and the way that we close here on this 4-hour candle, completely neutral. I'm not going to force anything for the 4-hour time frame and the 8-hour time frame. It's not favorable to do so. It's not ideal for me. I'm not going to force anything. I'm just going to sit on my hands and just let prices do its thing. No need to force anything to happen, right? One thing that I forgot to mention to you guys is that the weekly candle here is actually closing within like a couple of hours. So just keep in mind the weekly TGIF setup, right? If we're going to close in a bullish way, we should close within this little blue box here on this weekly candle. So just watch for that, right? Because it is Friday. But yeah, with that, I'm just gonna leave the technicals to its. I'm not going to force anything here on the technical side. I do want to read more into the fundamentals and just really see what the state just to see what the state of the economy is. So, I mean, like I said, 125% tariffs. China responded. That was what China responded with. Let's see here. 4 questions you should ask to combat the market chaos. So during these times, right, where prices are dropping, this is as a long-term investor, this is like buying at a supermarket that is in super discount right now. So we'll see. Let's see. This week's chaos in the financial markets reminds me of a nightmare I had years ago. Driving in my dreams on a familiar road, I approached an intersection with a stoplight whose rhythm I knew by heart. Suddenly, the drivers were lunging forward, slamming on the brakes, honking their horns, crashing into each other, swerving into the ditch. The stoplight had gone crazy. The top signal was green, the middle one was black, the bottom one was red. Somehow, green meant stop, black meant caution, and red meant go. The signals were switching randomly back and forth as strobe lights. That's when I woke up. Now, my old nightmare seems to have come true in the markets. The Trump administration's shifting signals about tariffs has sent stocks and bonds and investors' stomachs heaving up and down. The key to survival is thinking clearly and asking the right questions. You and me, we both do not like uncertainty. That's just something that is, it is programmed in our brains, right? As humans, we like certainty. We like to know things. And in times of uncertainty in the markets where, where Trump is essentially just he's playing cat and mouse, right? He's releasing these tariffs. The next day he has a 90-day pause period for it, and then he increases China's tariffs to 100. It's very back and forth. That uncertainty is not something that is favored by both the markets and investors. So let's see. Orderly, predictable rules of international trade are like the traffic lights of the world's economy. When everyone knows how the lights work, traffic flows smoothly. When the lights morph into something like my old nightmare, it's understandable why investors freak out. U.S. stocks have averaged a return of 10% annually over the past century. In just 2 days, April 3rd and April 4th, the S&P 500 lost 10.5%. Then on April 9th, it gained 9.5%, only to dive again the next day. Days have become years. That's key. The movement that we have been seeing in the markets recently is something that you do not... It's very volatile. And one day, right? On Wednesday, we moved, I think it was like 2,000 points. 2,600 points. That's not normal. That is not normal. The human brain automatically goes on red alert whenever new information is surprising. So this month's drastic changes in the market prices can make you feel you need to respond with drastic changes in your own portfolio. In a volatile situation, our brains tends to overweight the most recent events because the older evidence could be outdated and less useful, says Alicia, I'm not even going to attempt that, a neuroscientist at the University of California, Los Angeles. When conditions are volatile, we may be very quick to learn, but what we're really learning from it is the short term, which may not necessarily be representative of the longer term future. Now isn't the time to step on the gas by buying the dip, loading up on stocks whenever they slump, or slam on the brakes by dumping all your... Instead, ask 4 questions. What do you own and why do you own it? Meet with your financial advisors if you manage your own money. Update your measure of how much of your portfolio is in each broad category of assets. You can't make a reasoned decision about whether or not to sell if you don't know exactly what and how much you own. Why do you even own stocks? What has changed? Tariffs. Just look at the U.S. dollar, and the Treasury bonds have slumped since March. But people, companies, and markets and countries are remarkably resilient. They will bounce back, although anyone who claims to know how long that will take is either a liar or a fool. If you didn't already own this asset, would you buy it at this price? Nice. Alright, so I'm actually just going I'll go into my trading journal here, and I'll do a review of the pros and cons from last week and some things that I could implement that I implemented this week. And it is Friday, so there's not much of implementation anymore. Alright, so let's see. Coming into this week, what were some things that I should continue to do from last week, right? First, taking consistent trades. Every single trade I have or that I do take should be systematic. It should be consistent, and the strategy that I implement should be
like almost the same, right? How am I going to be consistent? Requiring a higher time frame objective, a model, and a entry pattern for every single one of my trades. Those three components, if I can meet those three components every single time I take a trade, consistency is like met every single time. So that's the first thing. Second, understanding SMT. SMT is essentially a indicator that shows you where there has been manipulation between the markets, right? If there's a lack of SMT between ES and NQ, we should have a continuation of that direction, right? So if there's no SMTs at the lows, we should technically continue lower to seek SMT. Vice versa. If there's no SMTs at the highs, we should continue higher to search for that SMT. And the complete opposite of that for the presence of SMT. So if there is SMT between the markets, between a swing high on NQ and ES, so if there's SMT, a possible reversal might be on the way. But yeah, so that's the second thing, SMT. Third, understanding that time is fractal, and you can apply these concepts, right? The power of three concept to every single one of these candles. The weekly time frame, the daily time frame. Every single one of those candles has a open, high, low, and close. If you know where prices wants to go on the daily time frame, you would have a directional bias. Same thing on the 4-hour time frame. If you apply the same theory, you would know where the next 4 hours should go. Time is fractal. Fourth, just being patient. Sometimes in these, really volatile markets, you might not have an entry pattern. You might not understand where prices kind of wants to go. If you don't know, be patient, sit on your hands, and allow your strategy to present itself. You don't need to force anything to happen. Like with this 2,600 point move higher, I didn't feel the urgency to force myself to be in anything, right? I'm simply an observer. If the strategy isn't there, I'm not going to force anything. And what can I continue to work on? Well, accepting the fact that the outcome of anything isn't up to my control. If you've done all the practice, you've done everything that you can. Now you just have to let it just play out, right? And that's just something that I have to learn to accept. There's only so much you are in control of. You can't control the weather, but you can kind of prepare yourself for that, right? If you know it's going to rain, or if it's more probable that it's going to rain tomorrow, you might want to bring an umbrella or wherever you might be going, right? So you can always pivot and adjust. Second, just paying close attention to detail. So some improvements here. Taking consistent trades. Like I said, how am I going to do that? Requiring a higher time frame objective, requiring a model, and requiring a entry pattern. Those three components makes up my strategy, and if I'm able to follow that, I am able to be consistent. Second, patience. Accept the fact that you're not in control of the markets. You can't be in every single move that the market presents, or I guess not presents, but in every single market move. Only whenever your strategy is present and it aligns with the market direction. And third, just focus. channel all of your energy on things that is going to benefit you and deepen your understanding of whatever that is that you're pursuing. And with that, I believe that's going to be all for today. We got, to recap, first thing we started off with is, taking a look at CPI, PPI. We noticed that there is a decrease in the expectations, or the actual results of CPI and PPI was actually lower, or it decreased compared to the forecasted, which isn't ideal, right? With lower demands in both consumer prices, or just lower consumer prices and producer prices in general, that could indicate that consumers aren't confident and that they don't want to spend anything. That's one of the components of a recession. I'm not saying that there is going to be one, but I'm just throwing it out there. We recapped how the daily time frame doesn't have a bias. I'm not going to force anything on the daily time frame. Same thing here for the 4-hour time frame and the 8-hour time frame. It's pretty neutral. I'm taking a very neutral, just observer stance. Watching it from afar, not really going to force anything here. And we did take a look at some Wall Street Journal articles here, understanding that, with the whole tariff situation between the United States and the entire world, how China's responding and how that's possibly going to affect the United States economy. And that's going to wrap it up for today's live stream.